Good morning, good afternoon, everybody, wherever you are in the world. We're very, very excited to have all of you here today. My name is Ephraim Chalamish. I'm a senior advisor here at Kroll and an institute fellow at the Kroll Global Institute. We're excited to have this joint event together with OMFIF and its leadership, together with Kroll. And first of all, I would like to introduce the speakers at today's event. Before I introduce the topic, we have Mark Sobel, the U.S. chairman of OMFIF. Hi, Mark. Thank you very much for joining us. We're very excited to have you with us. Then we have, all the way from Europe, we have Ms. Gwenola Chambon, who is the head of and the founder and the head of Vaban, which is a very fascinating, interesting fund investing in infrastructure. She's going to tell us all about it and her experience in the field. And then we have Carla Nunes from Kroll, who is also a managing director, an institute fellow, and also the head of valuation digital services here at Kroll, specializing, among other things, at the cost of capital project, which I recommend all of you to follow. I'll just say very, very briefly about the participants that we couldn't ask for a better group to cover such an important topic like investing in real asset infrastructure investing. This is a very timely topic. Mark brings more than 4 decades experience working with U.S. Treasury and representing United States at various international financial forums. So he's really well qualified to speak about the macroeconomic environment, issues like inflation, interest rate, investing in infrastructure as part of asset allocation, etc. Carla, as I mentioned before, is really one of our leaders in the space of valuation, risk management, and cost of capital, which is extremely, extremely important in the context of investing in real asset and infrastructure. And finally, it's so important when we speak about these issues to bring it from the abstract to the field. And Gwenola, more than 2 decades, really invested in infrastructure, in real assets. She brings a lot of experience both on the financing side and also on the investment side and managing the assets. And not only that she's a leading voice in Europe on these issues, but she also tries to take this story globally and bring the European view on real asset investing to some other parts of the world like North America and other regions. So we will cover today the things that we all think about quite a bit. Why infrastructure? Why now? Why the Biden administration is so busy talking about infrastructure investing? Why the European Union is responding with similar ventures? Why the inflation discussion is so relevant to the infrastructure investing story? What about interest rate? What about risk management? How ESG and climate change, all these fascinating questions are so relevant to the infrastructure investment process. These questions and others will be covered. We have about less than an hour, and I really encourage all the virtual participants to stay on board until the end, hopefully not the bitter end, and also to start thinking about questions and comments that you would like to share. I can promise you that I'll do my best. Our speakers will do our best to respond to most of them, and even if not, no worries, you can reach out to me and to the other speakers at the end of the session, and we'll do our best to respond. So, Mark, let's start with you. Everybody's talking about inflation. Everybody's talking about the changing macroeconomic environment. But before we talk about inflation and infrastructure and real assets and why sovereigns are so relevant to the discussion, you've been working with sovereigns for such a long time. And finally, you have this perfect storm where so many sovereigns are interested in allocating capital to the infrastructure and real asset class.
I start on inflation then while Effie comes back, since I think he was headed there. I think it's interesting in thinking about inflation, first of all, just to look around the world to start with. Inflation is not a problem in China. It's not a problem in Japan. There's been a tick up in Europe. There was a big print in Germany, which had a lot of interesting anomalies in it. But in Europe, there's a major output gap. So I think that the European inflation story is a far more muted one than in the US. Now, in the US, we've had this long this debate about transitory versus persistent inflation. I've never liked the distinction. Transitory implies time limitation, but nobody ever said what that is. So I think it's obviously safe to say inflation is going to be more enduring than previously thought, but the key question is, will it translate into a wage price spiral? So to think about it, where's the inflation coming from? Well, there's the supply side, the demand side. On supply we've had port backlogs, chip issues. We've had strong demand for durables at the expense of services due to lockdowns. So put differently, economists would talk about relative price changes. Used car prices go up, for example. But on the demand side, the U.S. has provided heavy fiscal support. Now, unemployment's at 4%. We in the U.S. are near our pre-pandemic trend growth line. That's a heck of a lot better than the alternative. But the U.S. stimulus probably has been too large and not well targeted enough. And it has been a factor behind the stronger price increases in the U.S. than we're seeing elsewhere in the globe. So what's the outlook for the supply and the demand side? So on the supply side, there have been recent indications some of the port backlogs may be abating. Many analysts see the chip problems easing in the second half of 2022. We know energy prices have plunged. We know the base effects from 2020 are being washed out. On the demand side, there's going to be a major fiscal drag in the United States next year. That should be cushioned to some extent by drawdowns of high savings from consumers. But the Brookings Institute estimates a 2% fiscal drag next year, 2% of GDP. I think we're still expecting decent growth in the US. Some of the major firms have it around 3.5%. But it obviously depends on Omicron and other mutations and uncertainties. Wages are up, but I don't see signs of a wage price spiral happening. If the labor share of income rises a bit, well, it's been depressed for decades. The Fed has shifted its stance since the October 6% and plus inflation print. We'll get another such year-over-year print later this week, likely. The FOMC meets next week. It seems foreordained that the Fed is going to double the pace of tapering from $15 billion to $30 billion monthly, which means the taper will end in the spring, and that will set the stage for rate hikes down the road. The markets are projecting 2 to 3 rate hikes. Obviously, it'll depend on how conditions develop. The Fed toughening and rhetoric has already tightened financial conditions. Now, one more factor in thinking about inflation, just is look out at the horizon. So I think about where is the global economy headed this decade? And I basically see very low growth in Europe and Japan. The US potential growth is coming in under 2%. And you're going to see a big slowing in Japan. That's going to have knock-on effects for commodity prices, emerging markets. So many forecasts for US prices show CPI falling by the fourth quarter of 2022 to under 3%, and then falling further. Even if prices were 3%, that's hardly going to distort investor decisions. So to conclude, I don't really see the inflation problem enduring or lasting into the future, beyond 2022.
Thank you very much, Mark. So just to kind of conclude your point, so you shared with us the macroeconomic environment, and clearly from your analysis, you focused on inflationary pressure, short-term, but definitely long-term. We see a different economic environment in the horizon, which brings the question of, so many sovereigns are looking into allocating more capital into real asset infrastructure investment, which is a long-term play, which is something much bigger than short-term inflation pressure. So the question to you, Carla, and then I'll get to you, Gwenola, kind of the view from particular projects on the ground. Carla, very briefly, how do you think this whole Mark's discussion, how it is relevant to so many sovereigns you've been working with when they think about the inflation risk and the other risk on the projects?
Thanks, Effie. So where inflation gets headed is, really important for financing conditions for example, emerging markets. So we follow inflation carefully, and as Mark was saying, it seems to be more of a temporary, and however you define temporary. I mean, the Fed chair, Jay Powell did say, let's drop the word transitory because it seems to be misunderstood by the markets versus what we meant by it. And it's more like what Mark said, like, does it have a big impact on spiraling wage inflation and market expectations? So will market participants really stop anchoring their long-term inflation expectations around a certain number? And just for example, we track various sources of consensus and academic expectations of what inflation will be in the long term. And we track this over time because it impacts cost of capital. And because every time we think about discount rates and cost of capital and financing costs, both from the equity and debt side, we think about long-term projects like real estate and like other, valuing a business. And so as an example, I'm just going to cite from work we've been doing back in April of 2021. So, 6 months ago or so, the median long-term average expectation for inflation, so over the next 10 years, from a variety of sources that we track on a monthly basis, was 2.2%. Now, we just updated the same data at the end of September, and that median was 2.5%. So the long-term expectations have ticked up a little, but not materially to be spiraling up, like Mark said. And so, so this is just some of the data that we track. But the implication, though, is if we do think that over the next year or so, there's a lot of, inflationary pressures, the Fed will be raising, interest rates, as Mark indicated, earlier than they probably thought they would be. And what we have observed from a risk perspective on a global basis is that when interest rates go up in the U.S., many of the sovereign issuances that issue in U.S. dollars, not only their cost of debt in U.S. dollars goes up. So if Brazil issued in U.S. dollars, or if Ghana issued in U.S. dollars, or some of these other countries, not only they go up, but they tend to widen the spreads between the U.S. and those countries. And that's where you can get into trouble in some of these infrastructure investments, because if the spreads widen enough and the governments in these countries will have trouble paying off their debts in US dollars, and that can have a bad effect on the economics of the local country. Now, real estate infrastructure investments tend to be a little bit more stable, that they have more support, and I'm sure Gwendolyn will talk about that. But it does mean that it puts the financing conditions more under strain in some of these, sovereign investments in some of these markets. And so even now, if some of you were following the September volatility in global markets, we just updated our country risk estimates for countries around the globe. We track about 175 countries around the globe. And we saw an uptick in risk, in perceptions of risk by investors to regions like Africa, Latin America, and so at levels back to 2020. And so it's possible that they will increase even further. And so that's something to be on the lookout in terms of financing these projects, and that there could be a higher risk in terms of like discount rates and cost of financing these investments.
Thank you, Carla. You covered quite a bit. You mentioned higher risk in emerging markets, the ability to finance some of these projects, the ability to pay in certain currencies. You referred to Mark's point about the fact that interest rates may rise a little bit earlier than we expected, which means that when we look at various real asset infrastructure projects, we have to build a different model. Let's take this wonderful soup that you cooked for us and ask Gwenola, when you make investment decisions, when you try to bring various investors and sovereigns to your operations as as investors, and you try to take all these information and apply it. What keeps you awake at night? And to stay a little bit more on the positive side, how do you see this new environment less as a risk and more as an opportunity for you all when you invest in European markets, infrastructure, and also the in emerging markets? Renella, the floor is yours.
Yes, thank you. So on my side, as an asset manager investing in infrastructure with a long-term perspective, effectively, these are the parameters that we need to take into consideration into investing in our projects. Currently, it's true that, as it was rightly said before, we have this tension on inflation that we can observe very concretely, having energy prices that have increased, semiconductors and raw material which have increased. So this is a tension that we are effectively perceiving, but from what we can see, it's transitionary, and what we are having as a perspective on the short term is that this is going to be really decreasing, as you know, the mismatch between the fact that people were actually consuming a lot of goods, compensating for the lack of capacity to use services, is going to be resolved with hopefully the end of the COVID. But after that, our perspective from what we analyze in the market is probably that on the midterm, inflation is going to go back. And the rationale behind is we are in a situation where we have the climate change to be tackled. And this is just major from OECD calculation. It's about $6.9 trillion, which will have to be invested on an annual basis on the next 10 years if we want to go back into a 2-degree scenario's trajectory. Mm-hmm. This means that all these investments which are going to be done in order to tackle this climate change are basically refurbishment of buildings, and these are consuming a lot of goods. And that is going to put extra pressure again in the future on potentially on inflation. We have also the phenomenon specifically in Europe, but I mean, you guys have the same in the US, where because of the COVID, European governments have been actually on the hook to maintain artificially their economies. And therefore, we have had a major injection of cash in our economies, having 75% expansion of cash created over the last 2020, which was just major. And this is creating extra pressure on pricings on real assets. This is true for real estate. This is true for infrastructure. This is true for private equity and stock exchanges, just the same. Having said that, what we observe is a very strong attraction from investors to invest in infrastructure. And the rationale behind is they feel that infrastructure is going to procure a natural hedge against inflation, because the vast majority of cash flows are effectively indexed to inflation. And then the question will be, what about the sovereign debts? Are we going to face a situation where interest rates are going to rise in the future? And so far, our expectation is that interest rates are going to be artificially maintained really low. And the reason for that is we have had such a surge of debt for sovereigns in Europe just to subsidize the activity of the economy. We will have kind of budgetary leeway, which will be afforded until the end of 2022. But back in 2023, we will have to go back on putting pressure to decrease those sovereign debts, and we expect interest rate to be artificially maintained relatively low. So no issue to finance projects, and rather a positive perspective for investments.
So you covered many fascinating points that I would love to follow up, and I'll pick just one, and I go back to you, Renella, on something, and then I'll ask Carla to respond as well. So it sounds to me that when you look at different projects, and we have around the virtual table our 100 participants, both from the investment community, but also from operational companies, asset managers, sovereigns, very diverse. When you look at these assets, sounds like your assumption is that kind of midterm to long term, the interest rate environment won't be significantly significantly different. And you think about Mark's and Carla's points, various points about pricing and about the inflation pressure, mostly as kind of forces that change market dynamics, supply, demand, consumers' behavior, which actually, from your perspective, it's even positive because it allows you to look a little bit differently at a particular project and financing long-term, which brings me to the question of the specifics. Can you share with us a couple of projects that either you executed or you've been thinking about, and how they are a good reflection of these new market behaviors, how the toll roads, airports, bridges, the kind of projects that you're looking at, it's a good reflection of these market behaviors and why sovereigns should look at them?
So regarding transportation assets, I must say that at least in Europe, the vast majority of investors are cautiously looking at their recovery. So for now, what used to be the bulk of the activity in the market, which was coming from the transportation sector, is really calm. And what we have is a very hot activity into what is energy transition or digital infrastructure. And these have become the major provider of opportunities. And where we see appetite is really having a chance to invest in projects which are going to be like, for example, district heating transactions. We have lots of opportunities of fiber, FTTH networks. All these are actually encompasses in new regulations that are implemented in Europe for projects to be more environmental friendly. We also have the digitalization, which is a major challenge everywhere. We've been actually all relying on connectivity during COVID. Now we have a major challenge, which is basically digitization of all the infrastructures. All of this is going to require a lot of CapEx, and therefore this is keeping everybody super busy. In terms of returns, interestingly enough, because also of regulation, we have this new European regulation in Europe falling on us, on all asset manager investors, which is the SFDR, whereby everybody will have to decide in which category they want to fall. And what we are currently observing is a major shift of all the world of investments from, landscape where ESG was a nice to have, where now it becomes a must have. And everybody has to shift that very significantly, having therefore all the money which is going to be channeled in specific projects, which is in a way a bit too black and white for now, because this shift is going to be positively channeled into some projects, but negatively will dry out some assets, which can become strained assets, really, no longer being financed when they are definitely required for transitioning from one economy to another. Because that is going to be quite a challenge. And pricings, I would tend to say, just to give you an idea, the world has become just crazy on, for example, renewable energy. Just to give you an example, nowadays you have a developer launching a project where he wants to deconsolidate and find an investor alongside him on an existing portfolio in Europe, and willing also to price the development and the repowering of his wind farms. He will be traded in the 6% IRR return. So the price is no longer fitting with the risk in renewable energy currently in Europe, which is a bit too bad, because it's a market which is super interesting, but because people are so mad at getting these assets, they no longer price them adequately.
And I think Gunalo, it's pretty clear that this unique transition point that you refer to, it has so many dramatic consequences. I mean, everybody, for example, talking about the dramatic shift in energy markets towards renewable energy and what it means short term for the demand of oil, gas, and coal. And it's not only that. When you look at transportation and other subsectors in infrastructure, the question is who's going to finance kind of short to mid-term all these assets which are less popular. And of course, it means that pricing-wise, the gap between risk and pricing will be even higher. And that's a perfect point for Carla to jump in. And then, of course, I'll ask Mark a related question. So, Carla, you spend a lot of time thinking exactly about that, about the gap between pricing and risk. You made a career out of it. You're well known for teaching the world how to price a little bit better. But I'm going to give you an even harder time, and I'll ask you even a more specific question, because Gwenella referred a couple of times to the dramatic rush towards infrastructure asset with strong ESG component, and she referred to climate change a couple of times. And all my friends and colleagues always ask me, because they know that I deal with that quite a bit. They say, Effie, everybody is trying to convince us to shift towards infrastructure and ESG, but because there are so many different ways to calculate ESG components and to quantify the risk and to think about the numbers behind it, we are afraid that by the time we make an infrastructure investment decision, which sometimes takes months, even years, because it's a long cycle, the whole market is going to be in a different place because the benchmark is changing, index ESG is changing, and the regulators are asking for different things. How do you think about this process, and what do you recommend your clients how to deal with that?
So, Effie, that's actually a challenging question, and we've received, questions for advice from both Europe and the US on like, how do we deal with, the cost of capital for ESG projects, and the one thing I wanted to make clear is that there is some confusion sometimes in the minds of like when you go to the financial press. In theory, if you think that everybody just wants to invest in ESG projects, that means that supply demand, Mark is always dealing with supply demand, that means that price of those assets are going to go up, but the returns you'd get from those, you'd expect it to go down. Yet when investors are flocking to this type of investments, they're thinking, oh, I'm going to get a higher return by investing in ESG projects. And those things are not compatible over the long run. In other words, you may have a temporary shift because a lot of dollars or euros or whatever it is like have been shifted to ESG investments. And therefore you have a realized return on those types of assets that is higher than you would have expected before. But it's not something you can really continue to see in the future if everybody says, I'm no longer going to invest, in these, quote, brown industries, and therefore I'm just going to invest in green industries. If it becomes more expensive to finance oil projects, etc., what it means is that at the end of the day, if they succeed, those investors are also going to get a higher return to compensate for their extra risk. So risk and return work in tandem. And so we're seeing that disconnect, and you see those disconnects in big times of turmoil, of shifting in industry trends. And in fact, I've been talking to an academic at Wharton Business School because he has a paper just on this with his co-authors, and it's called Dissecting Green Returns. And what they find is exactly what I just said, that yes, you had a higher returns realized by these investors in green assets, but it was pure luck. It was because there was this massive shift of investment flows into these markets, and you can't really expect that you'll earn higher returns all the time if everybody is just investing in, ESG positive type projects.
Sure.
So that's just something to consider. And so because of this, we're actually, in conjunction with the Kroll Institute and my group, we're embarking on our own study to try to realize, like, is there a relationship between, for example, those ESG ratings, like a company that has a really positive ESG rating, like versus a laggard? Is there a relationship not just on realized returns, but on expected returns? So we're actually currently doing that study. So hopefully we'll have something to tell you more on that in the next month.
Thank you very much. And by the way, the fact that we all struggle with the same questions is like the typical shrink phenomenon. It means that the world is real, and we eventually, this is a work in progress. So whether it's your project with the Kroll Institute or Grenola's work with policymakers and government officials to make sure that European government are investing more in the sector. For different reasons, I think these are questions that should be asked, and I'm very glad that we deal with the question of, the gap between risk and pricing and what it means for different assets in the sector. Mark, you've spent many, many years with the US government. You really have a deep experience how government officials are, how do they think about the process in terms of, and we didn't mention that yet, market stability, long-term planning, responsibility with respect to fiscal and monetary policy. So I actually would, although here you are not in an official capacity, but because of your deep experience, let's imagine that President Biden is kind enough to join us this morning or this afternoon to this session, and he is thinking about the dream scenario, how his infrastructure plan is executed. And he listens to Grenola's points about market dynamics and to Carla's concern about valuation and risk management. What do you think, what are you going to say to his advisors and the various officials, the various secretaries, how to implement the program in a way that we're going to avoid either bubbles in a few years or other market failures?
You're raising an interesting issue, which is that the Build Back Better agenda has been under discussion in the US for a decade and longer. And finally, despite Obama, Biden, Obama and Trump even pushing infrastructure week, as it's called, Biden got the bill through. But the political payout is not going to be now. It's going to be way down the road when these projects get built. So I think that it's a major accomplishment. It's a major directional change. It will have economic benefits, but a president is really going to leave the implementation to the ministries, to places like the Transportation Department, EPA, to hopefully bring out the teams of people to watch over the projects, make sure they meet procurement standards, make sure that they're economically efficient. It's also going to rely upon a lot of coordination with the states and localities. So it's a very, very complicated task. It's going to pull everybody together. And the president, as kind of the person up here that's got 1,000 things to do, is going to basically, hopefully, have a strong, solid team in place that carries it through.
Thank you. Gunilla, one of the questions that we've been asked as part of this engaging workshop is whether European governments, when they come up with proposal of fiscal spending and infrastructure investing in Europe, whether they have the courage, the vision, the ability to execute the same way as Mark just mentioned, after a long time to execute, they build a better plan. So I'm just curious, since you're one of the leading voices in Europe on that, what do you think? How the European government's going to execute on their promise? And for our listeners and our viewers, there is a similar proposal just came out of the EU a few days ago, and everybody's watching how the EU will respond. So Gwenal, the floor is yours.
What we have, because basically I was asked to be part effectively on a working shop with all representatives of European countries in all the same conference, where they wanted to brainstorm on what are the best layers to execute these plans. And it's very interesting because, at the end of the day, there are two ways. There is, the subsidies way, where governments are going to incentivize feed-in tariffs, lots of things to make, a business plan actually sustainable from a perspective of, for example, investing in hydrogen, which is for now, it's very venture kind of investment. It's not an infrastructure. So basically, there are ways of implying this through regulation and also with carbon pricing. So basically, the price of the carbon will be increased. And as it's increasing, people, obviously, businesses are going to take into consideration that and to adapt themselves. Or you can put them, a slap in the face and have tons of regulation coming to you, and you have to cope with it. And I think the best is a carbon pricing Because at the end of the day, you are going to crumble under so many regulations falling on you. What we are facing is that they haven't decided yet, to be frank. And when you speak about, with a different representative of different countries, each of them is brainstorming on the appropriate leeway to actually foster investment in their country in order to do a proper program. But each of them is actually trying to figure out a way to address it on his own way. So there is no global plan for now.
Gwenella, you always you remind us the usual structural issue with EU pan-European programs implementation, which is at the end of the day, each member has its own unique political and economic setting, and different countries have a different take on, for example, energy, infrastructure assets, etc. So the question is how people like us can really help them to bridge the gap. And by the way, there are many, of course, it's fascinating. There are many bilateral projects which actually bring together 2 or 3 different countries. And then, of course, the challenge for people like yourself is how you execute a project where a different government is taking a different direction. I'm just curious, before I get to Carla, on related question, Gwenella, you mentioned the price of carbon, and one of the questions that we just got a question from an audience member about the pricing of oil and gas, and I think that the interesting point here, you and many other European and American funds are looking at energy-related infrastructure assets, and many sovereigns are, of course, exposed to that as part of their growing alternative assets exposure. So the question is, now that you look at the world and you see how quickly prices are changing when it comes to oil and gas, what does it mean for your decision-making process when you think about the various assets in the market?
It is quite tricky, to be frank, because, for example, when we are looking at it, for example, I have a very concrete example, a district heating opportunity, which is in the US currently that we are exploring. This is super interesting. It's natural gas. So from the perspective of my European investors, they are just freaking out because they just consider, wow, this is natural gas. Why don't you do maybe something with, renewable energy sources? Because this is going to be, absolutely not aligned with a 2-degree scenario. When you talk to North American investors, they feel like this is pretty okay. So it's not easy. And when you see, for example, in due diligences, in fundraising, we have now, and it's new, only recently, pension funds, sovereign funds from the Nordics are now asking you to put an exclusion specifically on fossil fuels. So coal, oil, and gas are now eliminated from the scope of things they would like to invest in, which is showing you how things are perceived differently from one investor to another. So the way we tackle that is we do have exclusion for coal, we have exclusion for oil, but not for gas for now. And then our job is to figure out the way, because my funds are 25 years final. So the only way I can figure out a way of feeling comfortable is having to find a way where this is going to withstand the evolution of regulation, new taxation, which we are going to be expecting in the future, in order not meant to discourage businesses relying on this kind of energy and force them to move towards more renewable energies. And then if my business plan can withstand these evolution, which we are expecting on the next 15, 20 years, then it makes sense. But if not, then this is an asset I'm not going to invest in.
I appreciate the fact, Gwenella, that you shared with all of us this kind of tension between the American approach and the European approach to natural gas, because I think for many sovereigns, and I had a conversation with many of them on related issues, they kind of struggle with the question of how I invest more in energy-related infrastructure assets without taking a huge risk on being on the wrong side of the ESG discussion. So I think your question is very timely, especially, by the way, in light of the fact that at the end of the day, they are concerned about a rate of return because they are there for their citizens, for their nations, and it's very important for them to find the right balance between better returns and kind of market branding. Carla, just on that, if you don't mind, you speak to many funds, many sovereigns. Do you think that sovereigns, central banks, sovereign funds have a different take on what Granola just shared with us?
I actually think that there's a that challenge about the, how fast do you stop investing in, brown industry? So like the oil and gas and natural, it is a big issue. And I'm sure those of you in the UK, for example, have been struggling with the prices of electricity going up. The problem of like shifting too fast to renewable sources of energy when the infrastructure is still not there, enough to absorb the consumption of energy that the global economy needs, you can actually have bad repercussions for growth. And that's what, both central banks and politicians, although politicians sometimes are more worried about their next year's election than what is better for the economy. And that's my concern, keeps me up at night, is that you have to have a planned transition away from oil and gas. You can't just say day one, you're going to like shift away, because there's not enough energy production from renewable sources that can accommodate the growth. And if you stop, if oil keeps going up significantly, oil prices on a global scale, that may actually help some of the emerging markets that are dependent on that, but it will harm global economic growth in the sense that, particularly for economies that are very dependent on consumption. So as an example, the US, 70% of the US economy is driven by consumers. If things like oil prices, electricity prices, etc., start really biting and hitting your disposable income, you're going to retract on your purchases. And that has a significant impact on an economy like the United States. On export economies, it's not such a big deal as much. Maybe like Japan or Germany are not as impacted. But in the case of the US, you have to be careful about that transition. And that's what I would say, and I'm sure Mark can comment more on this, that's something that, central banks and politicians, as I said, governments have to worry about on how quickly you transition these sources of energy. And it's interesting also that even a BlackRock, who has been like this huge proponent of moving towards ESG investments and green investments, that yesterday they just announced a deal with Saudi Arabia for the gas pipeline of Saudi Arabia. They're going to like in a JV. I mean, it's like billions of dollars, like 15 or 16 billion billion dollars. I can't remember exactly, but it's on natural gas, to Granola's point. And it's interesting that these are the guys who are saying we don't want to have any more investments in these types of industries. Let's shift everything into like these positive ESG. And they're the ones saying like, well, we can't get away from this nonetheless, because it is a real impact for the global economy, for emerging markets and even developed markets. So like, how do you make this transition? And I think it's very challenging. I don't envy policy decision makers.
and by the way, Carla, this example that you just gave, I wouldn't describe it necessarily as hypocrisy or tension. Sometimes it's part of the kind of the transition that markets are going through, where you have leading institutional investors basically telling the market where we're heading in terms of ESG implementation, climate change, and valuation. But at the same time, kind of short term, they pick projects which kind of find a better balance between better returns and make the markets more accessible. Mark, I actually want to go back to something you said, and if you don't mind, before we get to the last stretch of this great workshop, kind of to speak about something a little bit broader when it comes to sovereigns. And then if we take one step back and we look at sovereigns' portfolio, and how they think about the world more generally. It's not only infrastructure, because today they're looking at so many diverse assets. You have sovereign investing in cryptocurrencies. You have investors talking to us about how you guys are evaluating central bank digital currencies, because we're thinking about having them as part of our portfolio. We see funds like Granola's thinking about bringing a new kind of investors into their pool. And because of this complex reality, the question to you, Mark, how the infrastructure part works with the bigger picture. How these sovereigns, when they talk to you, think about the higher risk or lower risk that these infrastructure assets are bringing to their portfolio.
Thank you for that. By the way, I would love to hear Carla and Gwenola comment on how ESG standards, the lack of thereof, taxonomy, greenwashing factor into the kinds of issues that Carla was just discussing. I mean, in terms of thinking about some of the sovereign investors, some of the central banks, they have massive portfolios. Typically in the olden day, when central banks thought about how to manage a portfolio, they thought about, well, you need to have liquidity, you need to be prudent. But then there's been such an accumulation of assets, and there's a desire to generate bigger returns that they've had to start thinking about more broadly. And so they thought in terms of equities and bonds and going out the yield curve and the like, and going not just investing in sovereign issuances, but commercial and whatnot. And so now huge portfolios, there's a desire, it's very tough to manage all this money in-house. There's a search for diversification, there's a search for greater yield. And so you start thinking more broadly about longer term investments, such as infrastructure, as you just mentioned. Maybe you outsource some to private equity firms, to hedge funds and whatnot. And then you're thinking about alternative assets, gold, or as you put it now, crypto. So I think that's the way they would perceive it. And crypto is extraordinarily volatile, I think, and extraordinarily speculative. And I think that would have to weigh on any sovereign's decisions. Public investors, it's my feeling, are a little bit more risk averse than private investors, because if there's transparency about whether you win or lose money, the public takes note of that, and that can be an issue.
And by the way, Mark, just so you know, there are some people out there who think about crypto-related infrastructure as infrastructure investing, right? Data centers, certain cables, and I'm sure that many funds or funds executives listening to us, they think about creative ways or creative definitions of what real assets actually mean, but that's really a long conversation for another time. Two funky or semi-funky questions as we get closer to the crescendo, to the last phase of this discussion. The first one is, when you look at private equity funds, most of them, if you look at the recent behavior, their exit strategy was either to go to public markets because capital markets have been booming, or of course the traditional sell. But in the infrastructure space, as we all know, it was mainly driven by kind of ongoing revenues and appreciation of the assets, because public markets wasn't really a real avenue. Recently, there are all types of initiatives to take some of these assets public. There are some initiatives in the EU and some other parts of the world to think about creating similar models like the REIT in the US, where you can actually take real estate portfolio public, also for tax optimization. Maybe we should do the same with infrastructure. Gwenola, when you have these discussions with your investors or with your projects, do you think about taking some of these assets public? Do you think that capital markets are a good avenue for investors in this asset class, and a good incentive to bring more capital to this important asset class to build a better world?
Frankly, no. I mean, and I will tell you why. And the asset class of infrastructure is relatively young. I mean, it has emerged per se just in the aftermath of the global financial crisis, when investors realized it was quite interesting, it was quite resilient, and it could procure some yield in an environment where bonds were basically no longer bringing any return. And now it is reinforced with, the COVID has just proved again that infrastructure were effectively super resilient, and in the current environment is very nicely yielding, where basically the rest of the world is getting negative yield performance on their exposure on sovereigns and bonds. And having said that, while we have seen this asset class grow, it has grown and multiplied by 8 over the last 5 years. At the same time, the secondary market for infrastructure has grown super fast by 25% per year. So it's huge amount of money which is going into a fund of funds dedicated to really animating this secondary market. So what we are observing is that the asset class is just evolving just in parallel with the private equity. It's this very little sister, because we do represent only 10% of the private equity aggregate amounts. I mean, the private equity gathers 7 trillion, while the overall aggregate amounts in the asset class currently is $700 billion. So the liquidity per se is actually coming from investors purchasing to each other the shares they have in funds, and that's reasonably procuring returns, and I don't think we will go in multiple IPOs in the future, because at the end of the day, it hasn't delivered so much value that you would get from selling from one investor to another.
That's a great analysis, because I can tell you there are many people out there who are thinking very, very hard, as you know, how to build certain structures in public markets to leverage the booming capital markets in this context. Mark, another interesting question that came up a couple of times today from various participants here is on China. Frankly, it's almost unreal to have this discussion without mentioning China's internal infrastructure boom, but also the role of China investing in global infrastructure projects. Obviously, you can spend hours speaking about that, Mark, but I want to ask you, before I get to Carla for the last words of this workshop, Mark, I want to ask you a very specific question. It seems like China in infrastructure is an interesting play and a different play in Europe in comparison to United States, especially when you think about the national security component and how different departments in the US, and you mentioned a few of them, which are relevant to infrastructure, the infrastructure story, and many of them make it more challenging for Chinese investors and the Chinese government to become part of this story in the US versus Europe, where maybe it's a little bit easier, although many European countries recently kind of followed the US route. What do you think? What is the role of China over the next couple of months and years in European and US infrastructure? Mark, please.
That is a great question. Clearly, I don't see China being a major force for infrastructure in the United States. There's quite a bit of tension between the US and China. There are areas where one could argue China and the US should be cooperating, global climate issues and whatnot. But I think given the national security overlay, and when you think of CFIUS, and then you think of the lack of predictability, shall we say, in the relationships between the two, and the national security dimension, as you mentioned, I just can't see that happening. As you said, Europe is, you implied two things. You implied that Europe feels in some ways caught between the US and China, and yet you've also suggested that Europe is taking a more skeptical view of China, and therefore kind of adopting some of the American outlook on China. So I think that's going to make it harder for China to provide infrastructure to Europe, and I think it's going to be harder for Europe to look to China going forward. And then I also, very quickly, I just also think more generally about China. I think there's just some very interesting issues about the future of the Chinese economy, given democracy, given the transition to consumerism, given the high amounts of leverage that may mean that China's sustainable growth rate is going to plunge. It won't be quite the force that we're all thinking about now, maybe 10 years from now, but we'll have to see.
Sure. Great. Thank you so much, Mark, for these very insightful comments. Carla, before I provide the audience with kind of my own comments and concluding remarks, there were a couple of questions about how these major programs that we discuss in details in the EU and United States, how it's going to create pressure on markets, whether it's inflation or other kind of macroeconomic and microeconomic factors. Very, very briefly, are you worried about these mega plans like the Biden's infrastructure plan or the European plans, how it's going to create market disruption?
If we stick to infrastructure investing, I'm not as worried about the impact on inflation, for example, than I am for further fiscal stimulus and more monetary stimulus. So if we stick to infrastructure, I believe that these are such long-term projects that the impact on inflation and things like that is not as accentuated. However, if you keep giving fiscal stimulus to economies that are overheated already, you may create bubbles in the process. And I have to say, despite all these conversations about tapering, which we know the ECB, the central bank in the Eurozone is not going to do it anytime soon compared to perhaps Bank of England or the US, etc. The reality is that the balance sheets will be much bigger for these central banks than they were in the past. We track this information since COVID, how much these balance sheets have grown, and they have doubled in size in like a year and a half. It's not like central banks are saying, we're going to stop reinvesting all of those bonds that are expiring. We're going to continue to purchase to keep sort of the size of the balance sheets. So there's still a downward pressure on interest rates, as Gwenola mentioned in her thinking, in that, yes, they will go up, but from a very low level, record low levels of interest rates. In general, I still think there is a downward pressure compared to history, compared to before the global financial crisis, that interest rates in developed markets will still be relatively low compared to what they were before. The question is how quickly they rise from this low level that can cause market disruptions. Because if investors are pricing a certain level and then interest rates change dramatically based on who their models were, you can really have market disruptions. But I actually don't think for infrastructure, that sort of investment, I don't think it's too inflationary compared to other measures that both central banks and governments can implement.
Thank you very much, Carla. One of the things that I learned from today's session, and I learned quite a bit, I have to admit, is that the relationships between governments and private sector, the relationships are more important than ever. It's important for private market participants and funds to understand how government think about certain policies and implementation of certain programs. It's very important for private participants to understand the terminology, what governments actually mean by using certain terms. And we gave many, many examples and many different programs. And I think it's very important for the private participants to spend time with government officials on understanding the terms and the implementation of the program. And vice versa, I think we all learned today that it's very important for government officials, sovereign funds executives, central bankers to spend time with private participants to understand much deeper what kind of challenges they're going through, whether it's on the fundraising side, interest rate concerns, inflationary pressure, diversification, different asset class. I think Gwenola's example examples on short, midterm, and long-term tensions in the energy market. Is a great example for that. So I think one of the main themes of today's discussion is really better connection between the public sector and the private sector. And I think today's workshop, which brought together the global economic community, OMFIF, and Kroll, is a great example for that. I want to thank Mark Sobel, the chairman, U.S. chairman of OMFIF. I want to thank Carla Nunes, our friend and colleague, managing director at Duff & Phelps Kroll and the Institute Fellow. I want to thank you, Granola Chambon, the head of the fund, for your insightful comments. And I want to thank all of you for joining us. And I really encourage all of you to be part of this dialogue. I got many questions. Unfortunately, I couldn't ask them all, from 5G infrastructure to digital signaling to more questions about China. But this is really the proof that the goal here today was really to start thinking about this asset class more seriously, to start thinking about all the various questions around it, and to be part of the story, whether you join a government program, or you join a fund, or you increase your participation in the sector, or you write an interesting paper, as Carla just mentioned before, on the academic side, or just by staying in touch and reaching out to us, each one of us, if you have any questions related to today's workshop. I wish you all a beautiful morning, afternoon, and evening, wherever you are in the world, and see you very soon. Happy holidays all. Thank you so much.
Thank you.